Hi everyone, it's me again. بس حطوا صورة مختلفة المرة دي. So I am really happy to be here on this one in particular. Because I think it's a topic that is possibly under-discussed. So we have with us on the panel private equity professionals, venture capitalists, and we're going to be discussing PE and VC. And as we go around, if you, when you first start speaking, if you want to provide context on your role, please feel free to do those introductions. Once again, we want to start with setting the stage, right? And so I'll actually start with Abdullah. If you could start for us by mapping the private equity landscape, its evolution over the past 2 or 3 decades, and then in particular, this last decade with the emergence of VC, and what impact that has had on the space overall.
Sure. Thank you for inviting me. Always a pleasure to be here. فخلوني ابتدي بالتطور الطبيعي للبرايفت اكويتي والفنتشر كابيتال. مصر بدأت في السبعينات والثمانينات يبقى عندنا I figured you're not following me. So Egypt started with commercial banking. So in the 70s and 80s, we have very good commercial banking experts because we had very good schools. So Chase Manhattan was here, Citi was here, many other multinationals who really trained people in the field of commercial banking. Then came investment banking, and investment banks hired from commercial banks. Some commercial banks made great investment bankers, some didn't. And then came private equity. So late 1999, early 2000s, we saw the rise of private equity. And private equity hired bankers, investment bankers. Some made good private equity players and some did not. And then came another change. So I joined the Egyptian Private Equity Association in 2016, and I have been the chair since. I'm very proud to be the chair of that association. And that association actually really portrays how the Egyptian market has changed. So we started with large private equities. So the 6 founding members were 6 large private equities who did large deals. And then over the years, we started welcoming SME funds. So there's still private equity, but more SME focused. And then recently, we found that we have a lot of interest from venture capital funds. So we changed the name of the association from the Egyptian Private Equity Association to the Egyptian Private Equity and Venture Capital Association. And just like what happened with commercial banking and investment banking and private equity, the same happened with private equity. The large PEs were sort of good training ground for SME funds. And some of the people who moved into SME funds moved into VC funds. Some will be good VC investors, and some may not be good VC investors. So, when you have a hammer, everything looks like a nail. But I think it requires different skills to be a solid venture capital investor versus PE investor. Some people get it, but not everyone will get it.
Thanks for that. I mean, I think that really resonates not only with people on the panel, but possibly Kamel for the audience. So narrowing in on VC, I'd like to get your guys' view. We'll start with Ali for the Egypt perspective, and then move on to Mariam and Walid for the regional perspective. So if you guys could just give us a sense of key growth drivers for venture capital, particularly, despite global recessionary pressures, the decline in venture funding that has happened in our respective regions hasn't been the same as other parts globally. What's behind that? We generally know there's an underpenetration in terms of venture funding per capita. We know that, but really, what are other triggers, and what's this persistent demand for this high-risk asset class?
Yeah, sure. Thank you very much, and super happy to be here with you today. From an Egypt perspective, I think looking at the past 2 years, 2021 and 2022, we had over 500 deals happening in 2021. 346 million exactly was all across different stages of VC investments, and probably one mega deal above 100 million. And then when you look at the growth rate that happens towards 2022, we're speaking about 3% in the total total funding amount, but 36% excluding mega deals that took place in 2021. That included participation from international investors, from regional investors, and from local investors. Maybe one thing to note is participation of international investors during 2022 became about 25% less than the year before. That was mainly due to kind of macroeconomic condition in the regions, a lot of challenges that we face, but still we've seen an increasing participation from regional investors who believe in the market. Key drivers, I think, is common. Everyone knows them. One of the biggest markets. I think we have a strong growth trajectory, particularly when it comes to multiple industries like fintech, e-commerce, and health tech solutions, which is enabling kind of other industries to come and flourish during that time. We're speaking about a huge market size. Between 2017 and 2022, internet penetration in Egypt have increased from 45% up to 70%. So along the way, a lot of industries have came up. We've seen the boom in the e-commerce industry and how a lot of solutions have becoming reliant on e-commerce and logistics and mobility solutions in kind of the day-to-day operations of what we have. So fundamentally, all the kind of keystones that you need in the Egyptian market is there. Talent is there, a lot of talent is coming back. Tech companies have been able to attract talents from corporate entities and retain them within the tech ecosystem for long. And then you have multiple fundamentals when it comes to how these kind of companies operate, utilizing the existing infrastructure that we have compared to the African nation and compared to the rest of the GCC. Although I expect to see this trend kind of changing in 2023 because we didn't have a lot of chance to kind of witness how this would be an impact, still the fundamentals that we're speaking about is still in place, and I expect more kind of participation from usual investors in the Egyptian landscape.
Mariam or Walid, who wants to take it? Key drivers for VC in Africa.
I think a lot of it
Do you want to try mine?
I think a lot of it already has been mentioned in terms of the fundamentals itself of Egypt as a market. But I think even to add to what was already said, when you're looking at Egypt specifically, you see that we're seeing two phenomena. One, there is the impact of the growth of the youth population, which is always a key indicator that you look at when you're thinking about markets that need to be more venture penetrated. And then the second aspect, which I also think is quite interesting, is a growing middle class. And especially when you're looking at some of the sectors that we've mentioned, e-commerce, fintech, and some of the solutions that are being driven by the growth of those sectors, the growing middle income class is incredibly important because they are the ones that are also triggering some of this potential of these solutions. And I think also they're the ones that are actually driving some of the necessity around these solutions. So from a venture perspective, I think that there are quite interesting fundamentals in Egypt as a market for it to be attractive. And then overall, I think when you're looking at the regional market and adding MENA and the rest of the African countries, you would realize that not only is a market that is underpenetrated historically, but also increasingly we need to increase the different forms of financing. And that doesn't just stop to venture itself. It has venture in it, private equity, debt financing, and it's incredibly important for us to also think about how those additional forms of financing are coming into the picture and justifying this growth.
And Walid, your views on what are you seeing throughout MENA, but in particular the GCC, because I think you can add a good perspective there.
I mean, Egypt is core to our strategy. I think we must have raised about $400 million, but $1.6 billion on top of it came into our portfolio. 20% to 25% of it went to Egypt. So we've enabled about $400 or $500 million here in the country on the tech side, over the past 13 years. And our new fund, which was launched last week, has a big allocation for Egypt. So, and I don't dissociate Egypt from GCC. For me, the Arab world, predominantly the three key markets, GCC, UAE, Saudi Arabia, Egypt, and some of the Levant have three characteristics that I've been observing for the past 15 years at least I'm in this industry. So one is the availability of talent and how fluid labor markets are. So it's very easy to go into one country to another. It's very easy. And with remote working and remote learning, this is becoming more and more interesting. So the talent pool is not just Egyptian, it's Egyptian plus the countries around you. Second is the level of integration of investments. So as I mentioned, and we're a small player, but small compared, probably big in the VC space, but VC is small compared to today is still small compared to the potential it can get. But when you enable a couple of $1 billion in the early stage tech industry, this means that the number is much bigger when you add up everybody over a decade. You have size, and that size is enabled by many people who collaborate across multiple countries, right? So the first point is labor, second point is capital movement, and the third, which is, I think it's the most exciting time to be living in the Middle East and specifically the Arab world, is the cultural integration. And you can see this. You can see this in Egypt, and you can see this in Jordan, and you can see this in the UAE, and you see it, I've been seeing it recently in Saudi Arabia. We have now a culture of tech entrepreneurs who are truly regional, if not global, with their thinking. So I've seen this also having started, many years ago. Before you didn't have that culture of belonging to a bigger mission. And I think it's exciting because that's accelerating more and more. The cultural driver, if you actually pay attention to it and invest in it, this is the source of FDIs. I mean, we're considered as FDIs because although we have a very strong presence in Egypt and an office here, but people label us as being Khalij because we're headquartered in Dubai. But we're an FDI player even in the Khalij market, we bring European and Asian and international investors to deploy in that market. In our market. So Egypt is a fundamental piece of our strategy. So that's why I don't like the label of being regional versus local, because I see those boundaries disappearing more and more. I don't think there's any case for Arab tech companies to think locally. At least it's not interesting for a tech VC investor, and it's definitely not interesting for any foreign direct investor who wants to invest in the country here, because one country is not enough. And that's a massive shift that I'm very excited about, and we're deploying a lot of money, and we're here for that.
Yeah, I couldn't agree more, and I love that you brought that up, because really, I think all of us, probably began investing in our native, country, and then at a certain point you do realize, and the more you read, you realize it's such a fragmented region that you really have to have extension beyond. And I love what you said also about, socially and culturally, how we view ourselves as part of a larger region. I think that is just imperative, right? And not being as, let's say, insular as we may have been in the past. So, Abdullah, on to you on when we look at the venture funding spectrum. Now, theoretically, and this probably happens more abroad, you have that handover from angels to early stage VCs to later stage VCs to private equity. Are we seeing that here, and if not, what links can be done to foster more of that? And embedded in that, I'm also asking, are PE firms looking towards the VC for pipeline?
Sure. I'll actually start with the second half because it's more interesting. So when PEs look at VCs, frankly speaking, you need the entire stakeholders to be aligned. So you need the investment professionals who actually know how to review and view VCs. You need an investment committee which is actually knowledgeable about VCs, and ultimately you need a board that understands what type of returns and what type of risks you're taking and agree to it. So you need to have the mandate, and it's very difficult to have all those aligned to do PE and the same people aligned to do VC. yes, there are a lot of similarities, but no, they're not identical. So the easiest way really for PEs to start, dipping their toes into VC and into startups is when you have a brick and mortar business, but it has a significant, tech piece. So recently, for example, the Sovereign Fund of Egypt, we invested in Silah Tilmiz, which is a K through 12 publisher. But what really got us excited is their online presence and the capabilities that it will bring to the market, democratizing the way you deliver education material to the masses. And really, you can then reach all governorates and all level of tuition brackets. So that's what got us excited. We have the same in agriculture. So agri-tech and ed-tech are two of the areas where we felt that we want to start with a brick and mortar business, but has a startup. So we have that exposure. We have that level of growth. We have that opportunity to learn. I'm not going to say risk-free, but at least you have something that you understand that incubates that smaller piece that may grow much faster. So will PEs do spin-offs that can then think about VCs? It depends on their experience. It depends on the stakeholders. So I find it much easier for, at least from where I'm sitting, for PEs to look at VCs embedded in PEs versus, the natural progression from angel to seed to A to B to C. The first method of financing feels to me much faster and much easier. The other one is more cumbersome, and it requires a lot of stars to be aligned. You can have, the best angel investor, but then, when you're at, the seed or round A or B, if the market conditions are not good, if the conditions within your sector are not good, you may have a few hiccups.
For sure. So a few things that came out of that I then want to throw off to other members in the panel. So Mariam, there's private equity returns have been challenged on the continent post-global financial crisis, right? Circa 07, 08, or post-2008. And so what you're starting to see now is some typically or traditionally private equity firms either setting up specialized VC funds or pushing more into venture, right? Like just off the top of my mind, there's Afrique Invest, quite active in the Francophone region, Helios, right? And so what impact do you think that's going to have on venture on the, on the continent? Is there someone from?
I think that something that you just mentioned that is quite key is that, especially following 2008, we've seen that there's been this slow progression for PE firms to have somewhat of a VC strategy. So some have either created dedicated teams or spin-offs, or even some have had somewhat of a fund of fund into VC firms to be able to have that exposure. Now, what we're seeing is, I think from a financing perspective, we are actually seeing that companies are looking at that from the PE side as being somewhat of a competitive advantage, right? If you're getting into the network of a VC firm that has a relationship with a private equity firm, you really see it as a competitive advantage from a value proposition from the VC side to basically have access to that industry expertise and potentially exit. So I think that from a company side, they are aware of this shift, and I think it has really brought some upsides from the firms who have developed that strategy. From a venture perspective, so for the rest of us who are more traditional VCs, to the extent that we've built that, we've now more and more have been looking into how do we build relationships with those firms. We are acutely aware that venture financing and private equity financing are very different from each other. And I think that we have no confusion in the fact that because the risk appetite is different, the approach to the financing is different, even the involvement in the deal post-closing is completely different. We have to be able to build those relationships over time to be able to have that, at least have those PE firms have visibility onto what's happening on the VC side. Also, what I've been noticing actually in the last few years has been with later stage companies across the continent today, we're seeing that their growth in numbers does not always necessarily match their growth in governance and structure. So they are fast-growing companies that are attracting incredible amount of capital, but then when you actually look a little bit closer into those companies, they are not growing at the governance and structure level to the extent that would make them viable products for PE or later stage financing. And now more and more, I've actually been involved in conversations where in the VC community, we are aware and trying to triage how do we make sure that we prepare these companies to be really on a path of growth that allows them to be viable products then. Because I think that, you know, part of what we've been historically focused on is how do we prove that these companies how do we prove that there is a market for these companies? And now more and more we're thinking, okay, how do we prove that there is a market? But we also have to make sure that these companies are built structurally in a way that they actually have a path towards that.
Yeah, and I'll always argue that that lack of institutionalization is answered by investment bankers, right? But I'm a bit biased there. So lots of great points that you brought up that I absolutely like, discrepancy between PE and VC, which I'll absolutely want to dig further on. But before that, I want to go to Walid. As one of the first funds in the region, and you and I joked offline about it being like one of the OG funds. So you guys have a number of exits in your track record, right? And so I'm wondering how many of those were to PE, not how many, were some of those, in case you can't disclose, but were some of those to PE firms? If yes, key lessons from a transaction structuring perspective. If no, why do you think that, you know, what can be done there?
Thank you. So great question, because there's no way you could survive this industry if you don't exit and make money. And metrics like DPI or how much our returns are extremely important. We're in our 5th fund, so I guess we've been doing something right. To answer your question is, we've had about 15 exits that are meaningful, and they've been all from this region, and divided in 3 buckets. We've had, on the trade sales side, we've either sold companies to international strategic investors who had a strategy of consolidation. So that's the typical thesis. You grow a company, you own a region, and then you sell it to a strategic who's consolidating the play. And we've done this many, many times, and it's been a very successful strategy. The other one is on the product side, is where you build companies who become extremely interesting from a product perspective and complement the product portfolio. And we've sold companies to NASDAQ companies, Nikkei companies, European companies. I'm actually listing, I'll talk about listing later. Those are pure trade sales that went on the back of product consolidation. The third bucket is regional. We've also sold companies to regional private equity players and regional family groups or family offices, basically corporates that have failed in their approach, that have actually not necessarily failed, that have chosen to acquire as opposed to build. Because we deal with tech companies and digital companies, and fastest way sometimes is buy versus build, and buy and we've seen this in the region. This is picking up. And finally, the listing. We did the first tech listing out of the Arab world on NASDAQ in a company called Mareme. So we've done the whole thing at A to Z in Mareme, from the seed to the IPO. And now we're listing another one in London, another tech company. It should be listing, if we got the initial confirmation, 21st of March. It's a software as a service company that deals in the IP management, right? So listings have become viable options. I'm lucky to have 2. But the most important part, the piece here, is that we're seriously been called by regulators and in UAE, Saudi Arabia, and hopefully Egypt I really have high hopes on Egypt, because Egypt listed the first tech companies in the region with the listings of companies like Fawri and what have you. Now we're having serious discussions on how to actually provide a viable exit path to companies that are born in this part of the world, where they can list locally, and actually investors, whether they're retail or institutional investors, can get excited about participating in those. And we're seeing the establishment of not just laws and regulation, but also establishment of market makers, the establishment of actual retail distribution through local banks, but also fintechs. We also did 2 super exciting investments last year about fractional ownership. One of them is going into the actually fund side, and that's crazy growth. I've never seen that type of growth from this company. 200,000 funded accounts in 6 months' time. Saudi company. Yeah, that's so. Also, we're starting to see participation on the distribution side from tech startups. Now, the missing piece, actually, surprisingly enough, is private equity buying, getting into the growth stage side of tech, because tech VC is diverse. You can do seed, you can do pre-seed, you can do Series A, Series B. We just happen to have covered the whole spectrum, and we haven't had a lot of participation. I guess it has to do also with the fact that the private equity industry is challenged in the Arab world in the past 5 years. I used to remember 2007, 2008, there was about 100 private equity companies in the Arab world, Egypt, GCC, and the Arab world. Today, I don't think there's probably, I don't know, I didn't count them, but definitely nothing close to 100. And a lot of them try to invest with us or buy from us, but it's just the DNA is not there. I think it has to do with the fact that the tech industry is nascent, so you need a certain expertise to understand how you scale it, and also maybe I remember Abraj investing in Kareem and making a 3x return on their investment. I know Gulf Capital did a lot of tech investments, but the portfolio, the tech portfolio and the private equities side is still nascent. So that's also an important piece. So with all these pieces, trade sales, IPOs, listings, fintech, and PEs, I think it's exciting times. I'm actually very excited about exits.
No, likewise. Something off of that, as we're talking about exits and private equity, not necessarily going into the growth stage as we would expect. I always try and infuse a discussion on valuation anytime I can. Alec knows that. And so I'm wondering, could one of the reasons be discrepancy around valuation? Where VC valuations are at versus where private equity is comfortable in entering? Is that something you might be seeing? You guys also, with Global Ventures, have a number of exits under your wing, for sure.
Yeah, sure. The short answer is yes. So I think, as Abdullah mentioned earlier, there is a difference in the mindset between a PE investor and between a venture capital investor. And the way that we approach businesses, even the way that we evaluate businesses, is extremely different. Where on the private equity side, they tend to rely more on fundamental valuation methods where they can value a business, versus a venture capital valuation method, which incorporates a lot of the potential of the company and where it's going to be over the coming period. So usually that put us in, all of us, like private equity and VC, everyone on the table, put us in a point of challenging point of debate or sometimes disagreement. But what I've seen is, and when I'm speaking about this, I'm not speaking about the inflated valuation bracket that used to take place in the market globally, not only in the region, but I'm speaking about the reasonable valuation brackets and period timeline. We started to see VCs to be little more reasonable in terms of how they value companies and what kind of approach and what kind of premium they can give on the future valuation, the potential of the company moving forward. But also we've started to see private equities try to kind of open up a little bit more and try to be more accepting to a little bit more premium to be paid for the potential of the company, although their financial historical performance is not as solid and strong as an incumbent player that have been in the market for long. We've seen this with a bunch of our portfolio companies, a few of them particularly tapping into the growth stage, and Series C maybe and above, solid traction, speaking about hundreds of thousands of merchants or customers in the market, solid track record over the past 2 years, and so on. So I guess we still have to see some sort of alignment and agreement on what would be the sweet spot that VCs and private equity are willing to meet at, because we are not there yet. And it really depends and varies according to industry. In fintech, it's a completely different game from other industries. While I think majority of the private equity participation as well came directly into two sectors. Fintech definitely was the first one. The second one is B2B e-commerce particularly, and that's where we've seen a lot of private equity engagement and participation. Private equity role as well over the coming period will play a pivotal role for the continuous growth of the tech ecosystem within the region, particularly on the growth stage side. In a economic slowdown, downturn, what we tend to see is a trend that majority of the late stage investors, international investors coming and trying to pour money into the region, they tend to fall back to their home countries. And we are speaking mainly about late stage investors that are coming and putting in $10 to $15 to $20 million ticket into some of our companies. That was the first wave was the 25% drop that we've seen in 2022, but now from the traction that we see on the ground is becoming much more or less, where the role of private equity funds, regional and local private equity funds, will become more important to kind of fill in that gap, because no matter how big our funds as VCs, we cannot put 20 or 25 or 15 even % of our funds into a single company. So there is a cap and there is a limit to where we can support and where we can help. So I think in 2023, and again, this is just a personal kind of expectations, we're going to see a better alignment between private equity practice when it comes to valuation and venture capital, and that's driven by the lack of international investors coming or the absence of international investors coming into the market, particularly over the coming 18 months.
Yeah, no, this is great. And yes, while I agree with Walid that, I'm optimistic as well, I think a lot of pain is going to be felt for some of these later stage, companies that will not be able to, get the funding that they want for exactly the reasons that you're talking about. Now, another thing that was brought up here reminds me of what Mariam was saying, and so I want to throw this out to you. A glaring difference between PE and VC revolves around ownership stake, right? With VCs, and you were talking about how fundamentally they look at transactions differently, right? VCs are looking for a minority stake, PEs are looking for a controlling stake, thereby definitively a majority. And so as some of the founders go through that experience and go through that growth trajectory, how do you guys manage your the founders in changing their mindset to accepting, going from, being the larger shareholder to, bringing in someone with a larger stake?
I mean, you're completely right in the fact that not only is it a change of mindset, but often, especially in more emerging markets, that change is quite brutal. Because when you're looking at from how dynamics work with venture, right, not only do they come in as a minority stakeholder, but they also come in as, a supporter, a cheerleader, in other words, to make sure that both the company and the founder are put in the best conditions to be able to succeed. Because also, when you're looking at early stage companies, there is so much of a bigger correlation between the success of the team and the success of the business, because it's still such an early company that it really relies on making sure that the team is successful. And when they get to a later stage, now it becomes completely different, especially when they enter the sphere of PE, because they're not running a startup anymore. At that stage, if they're even viable enough to be a PE product, they are running a company. And the founder's perspective is that the shift can be not only quite brutal and rapid, but also quite necessary. Because even, I think something that we may have not mentioned here is that the actual liability relies now on a PE firm if they acquire a company. So I think that one of the things that we've been trying to do over time with our founders, and that's what I mentioned earlier about not just focusing on the growth of the numbers, but also focusing on the growth of the structure of the company itself, is that trying to make this a gradual process, where once they're past the seed stage, starting to be able to actually implement certain fundamentals that allow them to understand that this company is going to be going through different phases of development. Whether it be actually starting to implement a board, a real board, and for them to understand the difference between fiduciary duties and what the actual board's implementation mandate can be. All the way for them to also understand from a founding team perspective, how do you bring in other executives who are much senior and who will be actually transitioning the company to have structure and processes that it actually needs to hold the type of headcounts that you have. And all of these transitions can be very difficult when they happen overnight, which is why we really favor trying to make them happen over actually the life stage of the company, and it being through every single phase of development that they actually go through, starting to implement and bring in these different concepts, so that by the time, if they are a viable PE product, it is still a shift, right? But it's not as brutal. And I've seen companies on the continent today that are great companies, high growth, but when you look at even their senior teams, there's not a single executive in that team that has priorly worked to a corporate that understands some of the processes that are required. And so I think it's also our responsibility as early stage investors to start asking these questions very early on and to start preparing them mentally that this is in the best interest of the company and making sure that their interests are preserved as well.
Yeah, for sure. And so, I mean, once again, that's some of the work that we used to do as financial advisors in preparing companies for whether an IPO or, a private equity transaction. There was a lot of corporate structuring happen and a lot of hires. So that brings us to what I want to talk about on portfolio management. So I'll throw this out to Abdullah and then Walid for, the different perspectives. Portfolio management, obviously very different for PE and VC. In PE, you're a lot more involved to a very large extent. You are held accountable for the performance of the company. If the company doesn't do well, that's on the private equity firm. Whereas VCs, on the other hand, factor it into how they invest, that chances are this is not going to go well. It's severely different, right? So commentary there on portfolio management in terms of private equity, VC, and we can,
Right. So let's start with PE. So the PE, the way you do portfolio management is really through board representation. So you're sitting on the board, you're getting involved in major strategic decisions. Are we listing? Are we exiting? Are we entering a new market? Are we launching a new product category? But you're not really responsible for operational issues. The talent that is housed on the PE side is more of a C-suite board type representation. I think when we think of VCs, these are people who would roll up their sleeves, get in on the action. They're really operational. Their role is really operational, helping identify growth opportunities. But the major difference is if things don't go very well for the startup, there's a fine line. Who's at fault? Is it the startup or is it the VC that's really, kind of hands-on, kind of in the office day in and day out? And that's interesting, but everybody accepts that risk. On the PE side, as you clearly mentioned, when you sit on the board, if the company's not doing well, that's a big problem for the PE, because theoretically you did your due diligence, your level and tolerance of risk is of a certain level that really you do not accept failure. So you automatically, start going into saving mode. How do I save that investment? And you'll do whatever it takes to save each and every investment. While as, in the VC space, the law of the numbers tell you that some, will not fare very well, and others, they'll fare great. And then when it's all said and done, the average is really what you're looking for, and the average is what makes your returns. So I think that's the major difference.
Walid, can we hear from you?
I see we have less than a minute left. So I guess it depends where you play. If you're on the very early stage, seed side, your support becomes a mix of operational, strategic, technology, talent build-up, emotional support. That's, comes at the early stage. And then obviously, when the stakes become higher, that shifts into what the company needs. I don't personally believe there's a separation in the importance of management, portfolio management. I think they're important across the way, all right? So any fund that says, we're looking at a spray and pray strategy, and there's no evidence to show from the data, because PE funds can have lower returns than VC funds and vice versa. There's no evidence that supports that there's less involvement or less passion or less skin in the game on both sides, private equity or VCs, not to do their jobs properly. It just, the job changes with the size of the company and the needs of the company. And they're equally, in my opinion, very important. The way we're set up is we have a very hands-on, very strong, even if we're a minority shareholder in every company, investment team that does a lot in terms of portfolio management. Not just from the government side, but even we go the extra mile. We're at a point where we're engineering our own exits, as well. So, I can talk a lot about that, but I think we always joke is when you make an investment, you just already made your first mistake, because when you invested, the money's gone. Khalas, you're not going to see it before you either get it back through an exit or, la samahallah, you write it off. And private equities can write off businesses. All that, this happens all the time. It's not just on the early stage side. The first mistake you do is exit. The first mistake you do is invest. And that's our mindset, because we've always looked at every investment we did as if it's, after all these companies are all our children, right? Mm-hmm. You don't favor one over the other. You have to look after them equally.
Yeah, I would agree with that. The ultimate control you have is right up until that point of investment. And beyond that, it really is, value creation, exit engineering, all that we talked about. Well, thank you guys so much. I had such a good, I really enjoyed this conversation. I had a really good time. And thank you so much for the audience. I'm glad we got to share with you, different perspectives on PE, VC, and the relationship between the two. Thank you.